Welcome back, ladies and gentlemen. I hope you all enjoyed your week off last week. I hope you actually spent it, having a bit of a break from your studies. I know there's a lot of assignments and things on for subjects that you're doing at the same time as audit. So I hope you got a bit of a break. I did miss you all, so it's nice to see you back. But I hope you're refreshed and ready for the rest of this semester. Now, it is the home run now. There's only a few more weeks to go. So stick with me, guys. If you are having issues and you're having questions, please do raise them. I'm here to help you as much as I possibly can, but I can only help you as much as you let me. So if there are things that you're not understanding, please do let me know so I can clarify it for you. Now, on that note, today's topic is we're looking at how do we design our overall audit approach, or our overall audit strategy. And I'm going to start talking to you about the different types of testing that we do when we're doing the audit, okay? So up until now, we've mentioned things like we do detailed testing, or we do less detailed testing. We're actually going to use the correct terminology today, and we're going to start going through what those different types of tests are. All right, and how the overall strategy is determined of how we're going to conduct the audit. So hopefully you're going to see how the elements are starting to link together. And please remember that the testing that we do in the audit is something that we're going to go through for the next couple of weeks. All right, and I'm going to start to bring some more practical exercises into the class as well, so you can really start seeing the link between the theory and the practice. So please bear with me, but ladies and gentlemen, I'll repeat this once more. I'm here to help you. Please ask questions. Okay, so here we go. The first element we're going to discuss, as I noted, is the audit plan and the audit programs, and then we'll talk about the importance of audit documentation. Now, before I actually go and continue on with the lecture slides, I want to show you a diagram that I want to put together using your input. So here we go, and this is showing you how the whole process works. So, ladies and gentlemen, the very first step in an audit, absolute first thing we do, once we accept a client, actually let me ask you this question. Once we accept a client, what's the absolute first thing we need to do? We need to gain a what? Starts with a U. Excellent. Gain an understanding of the client. So ladies and gentlemen, step one is gain an understanding of the client, of its business, how it conducts its operations and so on. Now, why is that important? It is once we have that understanding, guys, that we are able to undertake the next thing, which is called risk assessment. Now, risk assessment is when you are assessing two things: inherent risk and control risk. Okay, so you need to be really mindful of how this process works. Number one, you gain an understanding. How does the business work? Are they dealing with just within Australia, or are they an international business, which means that they do international transactions for different countries? In terms of the controls, how do the controls look? Does it look like they've got a really good system in place? Do they look like they've got checks within the processes to make sure the processes are happening correctly? This is all the understanding that we need to get. Once we have that understanding, we go ahead and, ladies and gentlemen, remember the word, we assess inherent risk and control risk. Remember, assessment means that we do not control it. We purely look at it and we determine, okay, is this risk low, medium, or high? Ladies and gentlemen, they're your options: low, medium, or high. Now, I'm going to give you a scenario, and I want you to tell me, in this scenario, would the inherent risk for the business be high, medium, or low? So, here's your scenario. We're looking at a business. It's a multinational organization. So, it sells to many different countries within the world. It buys its products from, say, Europe. It sells its products to Australia, it sells its products to Asia, it sells its products to America. Now, on top of that, the business has, the type of product that it sells requires a lot of judgment in terms of how they calculate the value of that particular inventory. Now, based off those facts alone, would inherent risk, remember the risk of material misstatement that comes from the nature of the business, would it be high, medium, or low? What is it, guys? I need more people that get involved. What is it? Absolutely. So in that case, this would be high. You know what? I'll just say high. All right. Now, in that same situation, same business, we look at their controls, the checks that they have in their processes to make sure it's happening correctly, and we realize they don't really have very good controls. And in most cases, they don't even have any controls. Now, in that case, would we assess control risk as high, medium, or low? Guys, this side, high, medium, or low? High. Remember, control risk comes down to how do the controls look? Do they look like they're good or do they look like they're not good? Controls, remember, they are there to prevent an issue or detect and correct an issue before it hits your financials. Now, if you didn't know this, please write it down. The better the controls are, the lower the control risk. So the better the controls, the lower the risk. It's when the controls are not good or they don't have controls, that's when you assess it as high. Now that's really important for you to understand, okay? So in this case, we're saying they don't really have very good controls, so that would be high as well. Ladies and gentlemen, Ladies and gentlemen, in this situation, we are dealing with high risk of material misstatement. There is a high chance that there are misstatements within the financial report because these are both being assessed as high risk. Now, in a response to that, in response to this high risk situation, would we do more detailed testing or less detailed testing? More, absolutely. So write that down. You would do more detailed testing. Okay, more detailed testing. I'm trying to squish it in because I need the rest of it, all right? We would do more detailed testing. Ladies and gentlemen, if you are in a situation where the risk, the assessed risk is high, the assessed risk is high, would you want your detection risk? Remember, your detection risk is the risk that your procedures will miss something. Okay, so if you're dealing with a high risk situation, come on in guys, would you want your detection risk to be high, medium or low? Would you want the risk that you miss something to be high, medium or low? What do you think? Absolutely, so write that down. We would want that to be low. Ladies and gentlemen, here's your link. How do you make sure that your detection risk is low? How do you make sure that there's a lower chance that you're going to miss something? You do more detailed work. That's the link, okay? So if you want this to be low, you do more detailed testing, okay? Now that, and this is the key, this, ladies and gentlemen, in this situation, we would do, I'm just going to move this slightly. In this situation, I want everyone to write this down. The approach, the audit strategy or the audit approach we would take is called substantive approach, okay, or a substantive strategy. So what's a substantive strategy? Guys, you're going to hear me say in just a moment, you're going to hear me explain to you about substantive testing. Substantive testing is the detailed testing, all right? And we're going to explain this to you as we go along. But every time I've noted to you detailed testing, what I have meant is substantive testing. So I want you to make sure you write that in your notes. Every time we've ever referred to, oh, we would do more detailed work, that means you would do more substantive testing. And I'll explain what that means in just a moment. Now, I just want you to show you the opposite of this situation. If we were looking at a different business and we assessed both inherent risk and control risk as being low, which means there was a low risk of material misstatement from the nature of the business. So for example, it just operated in Australia and it was dealing with products that were very easy to value. And the controls were really good. The controls looked really good. Remember, the better the controls, the lower the control risk, okay? So in this situation, when you're dealing with a low risk of material misstatement, do you think that we would do more detailed testing or less detailed testing? Absolutely, write that down. So here was more, and here we would do less detailed testing. Now remember what I just said before. Detailed testing, that's talking about substantive testing. So in this case, we would do less substantive testing. The detection risk would be high. Now remember, I'm going to repeat this one more time. Detection risk is the risk we are willing to take that our procedures do not pick up the issue. Now in this case, you might be thinking, why would we want that risk to be high? Ladies and gentlemen, in this situation, we're okay with this risk being high because it's a low-risk situation. We don't think that there are material misstatements anyway. So we're okay with performing less detailed work and therefore having a higher detection risk. Remember, these two elements are connected. The more detailed work you do, the lower your detection risk becomes. The less detailed work you do, the higher your detection risk. So please make that connection in your notes as well. And in this situation, the strategy we would undertake is what's called a controls-based strategy. What does that mean? Here's your final link, guys. Control risk. Actually, let me ask you this. If you assess control risk as being low, does that mean that you think the controls are good or the controls are bad? If you think it's low, you think they're good. Ladies and gentlemen, that's why you're going to test them. That's your link, okay? If you think the controls are good, therefore you assess it, control risk as low, you will go ahead and you'll focus on testing the controls as your strategy. That's your link. So the approach that you take would be a controls-based approach. Now, in the other situation, we don't think the controls are very good. That's why we assess them as high. In that situation, we would focus on more detailed testing, which is called substantive testing. So that's your link as well. Now, throughout today's lecture, I want you to keep coming back to the notes you've just written, okay? Because this tells you the overall view of how this process works. And please let me remind you of one thing. How you got here was based on your understanding. So gaining an understanding of the business, that's why it's so important, and that's why it's the first thing that we do. Because based on that, we determine the risks, and based off the risk, we determine our strategy, which is our audit plan, which is the topic that we're going through. So please be mindful, that's kind of the overall, the conceptual way that we're going to be working today. Now, before I go anywhere, are we all right with that? Are there any questions? I will be repeating this again. If you do think that there's a lot of repetition, that's a good thing. It means you're getting it, okay? But it's really important for you to see how things are linking to one another. So let's get straight into it. So we're talking about the overall audit plan and the 5 types of testing that we do. So here we go, very, very important. I want you to start highlighting these ones because it's that important. Now, the very first type of test that we do is called the risk assessment procedures. Now, you all know how to do this because you've already done it. Risk assessment procedures, as the term suggests, is when you're assessing the risks. What are you assessing the risks in relation to? Inherent risk and control risk. Remember, you gain the understanding of the business, you then perform risk assessment. That's when you assess the risks. And we have 2, inherent risk and control risk. So that's a type of audit test that we do. Ladies and gentlemen, what I would like everyone to write next to it, you do that at the very beginning of the audit. So risk assessment procedures, that type of test, it's at the very beginning of the audit. There's a reason I've put them in this order, all right? So risk assessment happens at the beginning. Now remember, once you have assessed your control risk, now this is very important, if you assess your control risk as either low or medium, now remember what this means. If you assess it as low, you think the controls look good. If you assess it as medium, you think the controls look okay. If you assess it as high, that means you don't think the controls are good. So, why is this important? And remember, this is the flow on from here to here. If you assess your control risk as being low or medium, that's when you would do controls testing, okay? If you assess your control risk as being high, which means you don't think the controls are very good, you're not going to waste your time testing the controls. Rather, you're just going to focus on the detailed one, which is your substantive tests. So it's really important for you to make that distinction. You would only go ahead and start doing controls testing when you think the controls are either good or okay, right? So then you go ahead, you test them to make sure they're actually working. But if you think that the controls don't even look good, you're not going to waste your time. You're going to go straight into your substantive detail testing, all right? So please be mindful of that. Now, the substantive tests are broken down. There are 3 types of substantive tests, and I will go through all 3 of them with you. But for now, I wanted you to see that connection. So what we just did in that diagram flows onto here. So again, really important that you see the sequence of events that happen. By the way, what this also means is that risk assessment procedures happen first, then you've got your tested controls, or controls testing as I like to call it, and then you do your detailed ones. Okay, so that's your order. Now, as I mentioned earlier, the risk assessment procedures, they're covered under ASA 315, and again, it links back to gaining an understanding of the business and assessing inherent risk and control risk within that business. Remember, it's you get an understanding, you assess the risks, so it's understanding, you assess the risks, which is your inherent risk and your control risk, and it's based off that, as you saw in the diagram, that you determine your strategy. Okay? That's your link. So all of these things, they feed into each other, all right? Now, remember, with the testing that we do, we've got controls testing and we've got substantive testing. Now, before I go anywhere, I want to just distinguish these two for you. Controls testing, first of all, a control is any activity, any task, any check that the business has in place to make sure the process happens correctly. Let me give you an example. If one of the tasks that they have in place is that a manager has to sign a particular purchase before it's processed, that's a control, okay? Remember, a control will deal with the risk. So requiring a manager to sign a document before it's processed, that's trying to deal with the risk of the wrong documents being processed or fake documents being processed. Okay, so every control is there to deal with the risk. So getting a manager to sign off on something before it's processed, that's a control. Now, what we would do as part of controls testing is we would test this. We would get a sample of these documents and we would check that the manager's signature is there. That's a controls test. What controls testing is focused on, making sure the process is happening correctly based on how it's supposed to. So they tell you, oh yeah, in order for us to purchase something, the manager has to sign off on that document. So we get a sample of those documents and make sure that the manager's signature is there. That's controls testing, okay? Now the types of procedures that we do, and notice what I'm about to highlight to you, the types of procedures that we do in this area is we make inquiries of management or the appropriate personnel. How does the process work? How does the control work? How does the control work? We inspect documents like this one here. We inspect the documents to make sure the policies or the procedures that the business has in place to make sure that the process is happening. We observe personnel conducting control activities. We re-perform certain procedures that the client has performed. Ladies and gentlemen, why did I highlight these four? These four terms should be quite familiar to you because we talked about these as the different types of audit procedures. Why did I highlight them? To link it back to the topic we discussed a few weeks ago. And secondly, ladies and gentlemen, this is the correct terminology to use. What you're going to have to do in this subject, and by the way, in your exam, is I'm going to get you to design procedures. So I'm going to say, look, this is the risk or this is the scenario. What procedure are you going to do? What test are you going to do and how are you going to do it? When you tell me the procedure, you've got to use the right terminology. You don't say look at, you say inspect, okay? You don't say watch, you say observe, okay? You don't say you match this document to this document, you say I vouch this document to this document or I trace this document to this document, all right? You need to use the right terminology. A lot of how I mark you is going to come down to you using proper language, okay? So please be mindful of that. Excellent. So these are just some examples. This particular slide as well, this is giving you further examples of types of controls and also the tests that we do in relation to them. Now, one thing I'm just going to mention here is, guys, it's actually not that difficult to design a procedure. All you really need is what's the control supposed to do, and then you test it. So let me give you just one example of that. And this is something that we did in Johnson & Johnson, for example. So businesses now, and I'm going to mention this later, but businesses now more than ever before, they rely on their IT systems, okay? A lot of the processing that happens in their IT systems. So one control that you might see when you enter industry is that when a customer comes in and places an order, the person that enters the customer's information into the system and also enters the amount of the sales order, like the value of the sales order, a particular control that might be in place is that the system will check this order to the customer's credit limit. Now, if you don't know what a credit limit is, and this is really important, so you might want to write this down. A credit limit is in a business, some businesses, they will have a maximum amount that they're willing to sell to a particular customer, okay? So for example, Diego, comes to my business and he places an order. Let's put numbers into it so it makes more sense. He places an order for $100,000 worth of shoes. I sell shoes, okay? Now, my system, when I put this information into the system will then check Diego's customer profile to see what the credit limit was. What's the maximum amount I'm willing to sell to Diego? Now, the system checks that and notices that the maximum amount I was willing to sell to Diego, their credit limit was $50,000. Now, let me ask you this question. In this scenario, would you expect the system to accept or reject the order? Absolutely. Ladies and gentlemen, that's a control and that's how it's supposed to work, okay? Now, once you understand how the control is supposed to work, it's pretty straightforward into how you would design a test for it. In this case, I could, for example, enter in a bunch of different customers' information into a sales order and put in a number that I know is exceeding their credit limit to make sure that the system rejects it. If the system does reject it, it's working. If the system accepts it, it's not working. Now, when I say it's working or it's not working, the control is working or is not working. Let me ask you a question. Is it possible that we assess control risk as being low or medium, okay, and then we go ahead and we test it and we find that it doesn't work? Is that possible, do you think? So is it possible, for example, in this example that I've given you, is it possible that we put in this sales transaction, we know that Diego's limit is $50,000 and the system accepts it? Do you think that's a possibility? Yes or no? Yes. Good. It is a possibility. Why? Because guys, just because they have controls in place doesn't necessarily mean they work. And that's why we test them. Yeah? When we make the assessment, we assess it purely based on how it looks. They tell us, oh, we have this control in our system that rejects any order that's above a customer's credit limit. They tell us this. And we say, oh, that's a really good control. So based off that, I assess control risk as being low. But I go ahead and I test it. I test it to make sure it's actually working. Now, why do we do that? To gain comfort. Once we realize, yes, it's working, it's doing what it is supposed to, I can rely on the control. And if I rely on the control, I can do less detailed work, which is substantive, all right? But if I realize that it doesn't work, even though it looks good, it's not doing what it's supposed to, ladies and gentlemen, that is when you shift. And you go and you do more substantive work, okay? That's how it links. So it's really important to do this testing stage because that's going to determine, can I rely on the control or should I just do more detailed testing? Okay, does that make sense? Just head movement for me? Yeah? Yeah? People in the back? Excellent. Okay, good. Now, what is that more detailed testing? Ladies and gentlemen, every time I've referred to testing as detailed, I'm talking about substantive testing. Okay? You need to start using the right terminology. So substantive testing is what we're referring to. Now, with substantive testing, as I noted earlier, there are 3 types. The first one, I'll highlight it. The first one is substantive tests of transactions. Tests of transactions. What's your focus, ladies and gentlemen? The focus, in this case, is verifying specific transactions. If you don't know what a transaction is, ladies and gentlemen, please write this down in your notes. A transaction is when we're looking at debits and credits. Okay? So I'll take the S out. Debits and credits. What do I mean? If you're looking at a particular actually, you know what? Let me do it this way. We're looking at certain documents here, and the documents are ultimately processed into a journal. Okay, we'll do it that way. Now, listen very carefully. If I'm looking at a particular journal and I want to make sure that this journal was correctly recorded, so the dollar amounts, for example, the dollar amount is correct. I then say, okay, I'm going to check this by verifying it back to the supporting documentation. Now, let me ask you this question. Let's see who remembers this. If I am starting at the posting, at the journal, and I am checking it back to the supporting documentation, what procedure is that? Well done. Yes, absolutely. Vouching. Good. Good. Yes, remember that. All right, good. Now, if this is a sales transaction and you're vouching it back to the supporting documentation, which assertion, this is the links, guys, which assertion is that giving you comfort over? Occurrence of the sale. Absolutely. Does that make sense? You got to start seeing the links between your procedures, your assertions, and what the procedure is called as well. If you were going the opposite direction, if you were starting at, for example, the sales order or the sales invoice, and you were checking that it was recorded correctly, so you're going the opposite, you're going from the beginning to the end, what's that called? Tracing. Absolutely. Okay? And in that case, you're checking that it's been correctly recorded or that it's complete. So accuracy or completeness. Okay, good. Now, ladies and gentlemen, that's a test of transactions. When you're focusing on a particular posting, debit, credit, that's a transaction. All right? Now, I just want to add one more thing here, and that's to the distinction between a substantive test and a controls test. Please write this down. A substantive test is any test that focuses on one of three things, or either of these three things. Number one, dollar amount. As soon as you are performing a test and the focus of the test is this the correct dollar amount, or looking at the numbers, that's a substantive test. So in this case, when I was checking the dollar amount of the journal, that's a substantive test. Secondly, if you're looking at the quantity that's been recorded, that's a substantive test. Thirdly, if you're looking at the date at which the journal was posted and checking that that was correct, that's also a substantive test. So if in the test that you are looking at, the focus point is either the dollar amount, the date that it's been posted, or the quantity involved, it's a substantive test. If you're looking at anything else, if you're looking at the manager's signature for approval, or you're looking at the fact that there was a sales order or a sales invoice that related to the sale, but you're not checking the details, that's a controls test. All right? Controls testing tries to make sure the process is happening correctly. So the manager signed off before it was processed, for example. A substantive test is looking at, is this the correct dollar amount? Is this the right quantity? Is it the right date? All right? So you need to start making that distinction between them. Okay? Now, in this case, as I mentioned earlier, if I was looking at a sales invoice number, and I was just making sure that it was posted, but I wasn't checking the details, so I wasn't checking the dollar amount or the products involved or the quantity, that's a controls test. You're just making sure it's there. But if I was looking at the actual details of it, that's a substantive test. And why did I just say details? Because substantive testing is the detailed one. Yeah? That's your connection. All right? So that's the best way for me to explain it to you. I remember when I was in your position, years ago, this was the hardest thing for me to get my head around. I was like, I don't get what's the difference between controls and substantive. Use these indicators, all right? Use these indicators. And we're going to work on this over the next couple of weeks, but this is the best way that I could think of explaining it to you. Now, the next one is analytical procedures, which is on the next slide. But there's just one more thing I wanted to mention at this point. Remember your tracing and your vouching. Remember the correct terminology. And remember that if you're looking at these three things, quantity, dollar amount, and date posted, it's substantive. So the second type of substantive test is analytical procedures. Now, one thing I do want to mention, I want everyone to write this down. Ladies and gentlemen, this is the most basic type of substantive test. Put that aside. Basic type of any test. Analytical procedures are the most basic. Why? Analytical procedures is when you're analysing the financial information and you're doing three things. One of three things. Number one, you're doing trend analysis. Okay? You're doing comparisons. Now you can be comparing the data to budget. You can be comparing the data to last year's financials. You could be comparing it to industry, the industry average. That's all analytical procedures. And the final type of analytical procedure we do is ratio analysis. Okay? Now, I mentioned this to you all last class, I should say. Very important. Very important. Very important, okay? You need to know ratios not only in terms of what the ratios are telling you about the business, but more so, what's the ratio telling me about where the risk is? Remember, when we as auditors talk about risk, we're not talking about is the business going to not perform very well? It's about where there's the risk of material misstatement. The numbers don't look right compared to what I know about the business, okay? So that's why we do analytical procedures. At the end of the day, where we're trying to find with analytical procedures is unusual relationships or unusual trends. Because they're the areas, and here's the link. Remember, this is the most basic type. They're the unusual areas, they're the ones that we're going to do more detailed substantive testing, okay? So this is a type of substantive test, but the areas that this picks up as high risk of something being wrong, they're the areas that I would do more detailed substantive testing, which is the test of transactions, which we just discussed, and the test of details of balances, which I'm about to discuss. Okay, so just be mindful of that. That's basically the intention of analytical procedures. And again, it covers these three things. We do trend analysis, how it's moved over time. We look at the comparisons between how the business is performing and industry, for example, and ratio analysis. That's a big one, and that's the activity you'll be doing in your tutorials today. And you need to know it. Okay. Did I tell you that I wrote your exam last week? Okay. The third one is the test of details of balances. Now, this is the third and final type of substantive testing, okay? Now, this one is also detailed, hence the name, details of balances. But the difference between this one and the test of transactions, you know what? Let me show you this in the most basic way that I can. And I apologize if this brings back some memories for some of you. A T account. Ladies and gentlemen, accounting A, all right, a T account. Now, believe me, this is the best way for you to make this distinction. So, for example, we're looking at the T account for cash. Oh, okay, let me ask you this question. Where would the opening balance be? On the left-hand side or the right-hand side? Oh, God, okay. You're right, it's on this side. Okay, opening. Okay. And where would the closing be? Same side. All right. Oh, okay. Now, why did I do this? Ladies and gentlemen, within your T account, you have your debits and your credits. Now remember, this is cash. So all your debits is when money is coming in, you're receiving money, and all your credits is when you're paying money, all your payments, okay? Ladies and gentlemen, every single one of those is a transaction. So if you are looking and you are getting verification for any one of these, you're doing a test of transaction, okay? Here's the other way you can test. Instead of testing the detail within your T account, you might just want to get support for the ending balance, just this one here. Ladies and gentlemen, that is a test of details of balances. There's two ways that you can test an account. The first way is you can gain support. The first way is you can gain support and you can verify all the details within the transactions within the account, and you can get those and match them to supporting documentation, or you can just get support for the ending balance. Okay, they're the two ways of gaining comfort. So you either look at all the details and add it all up to get the total, or you can just test the total. Now, the one thing I want to mention, actually for the first thing I'd like to mention, is this is mainly done for balance sheet accounts. And in particular, we do it for two main balance sheet accounts. The first one is cash, hence why I used that example. The second one is accounts receivable. Okay, they're the two that we usually focus on testing the total. And the best procedure that we use for that, now not to say that you can't do it for other ones, but they're the main two. The best way to test that is through confirmations. Again, you've heard this term before. We discussed it as part of the types of procedures we do. External confirmations. How do we do it? Well, if we're looking at cash and we want to gain comfort that this total number is correct, we can send a confirmation to the bank. And we can get the bank to say, is it true that the company has, say, $1 million in their bank account? By getting the confirmation from the bank, we have been able to verify or gain comfort that the total is correct. Ladies and gentlemen, details of balances. That's what that is. If I rather than doing that, looked at the detail in here and I checked the debits and the credits, that's a test of transactions. So that's your distinction. Transactions is the things that make up the total account balance, whereby a test of details of balances is when you're just focusing on the total. All right. Now, another way that we can do it, so as I mentioned, confirmations. Oops, sorry. One moment, I'll bring it back up for you. Apologies for that technical issue. We are back. All right. Did you catch everything that I said before it went blank? Yeah? Okay. Now, coming back. So with the confirmations, we can do confirmations for the cash account, which is when we confirm with the bank. We can also do confirmations for accounts receivable, guys, by confirming with the customer. Yeah? We can send a confirmation to a customer and say, is it true that you owe the business $10,000? And then if the customer then comes back and says, yes, that's true, then we have confirmed that balance. Okay? Again, notice what I said, confirm the balance. Hence why it's called tests of details of balances. The other one that we can do, I'll just mention very quickly, is with inventory. We can gain comfort that the total balance of inventory is correct by counting it, doing a stock take, for example. Okay? So again, we have 3 different types of substantive tests. What's the most basic? AP, analytical procedures. The other 2, they're the detailed ones. Now, this slide here, it's a pretty good slide in that it actually shows you kind of the link between your the different types of testing that we've been going through, which is these ones here, and the different types of procedures that we can do. So can everyone please make a correction for me? Instead of saying type of evidence, can you please write types of procedures? Because I'd rather you actually focus on it as types of procedures. So types of procedures can be physical examination, confirmations, as we discussed, documentation or inspecting, observation, inquiries, and so on and so forth. Now, what this particular table shows you is given what type of testing you want to do, which procedures are appropriate for doing that. Now, I like this, but if you, and some of you are already in my tutorial, another way that I explain this in my tutorial, and I'm going to repeat this again, I think next week and the week after, so I might elaborate on it further then, but what you can do is you can actually identify, this is another approach, identify what's the risk. So for example, actually let me show you the whole process and I'll do an example. What's the risk? Once you know what the risk is, identify what are the accounts impacted. Once you have the accounts, link it to what are the assertions relating to those, and once you have that, what's the procedure I should do? Let me give you one example of this, but I will bring this up again in the future. Let me do it this way. Okay, for example, risk. If the risk is that the sales transaction has been recorded at the incorrect dollar amount. Now listen to me very carefully because this is a really good example to see whether you're understanding or not. If the risk is that we've recorded it at the incorrect dollar amount, they've recorded it at the incorrect dollar amount, the sales transaction. What are the accounts affected? Think of the journal. Go to the journal. What are the accounts affected if it's the wrong dollar amount? Excellent. Accounts receivable and sales revenue. Go to the journal. That's the best way for you to understand this. And guys, this is what I kept on saying. Accounting is here, audit is here. If you don't have a sufficient amount of accounting understanding, you're going to find it much harder. Okay? So go to the journal. You would debit accounts receivable, credit sales revenue. So the accounts affected are those 2. What are the assertions affected? So remember, if the risk is that it's the incorrect dollar amount, What's the assertion relating to sales revenue? Dollar amount being wrong. Accuracy, good. What about accounts receivable? Oh, we haven't talked about this in a week and you've forgotten. That's not good. Valuation and allocation. Now remember what we just did. This is why it's so important to go back to the journal. Because if you said, oh, the account affected is sales revenue and its accuracy, you've only got half the answer. Yeah? Because the other side of it is accounts receivable and valuation and allocation. Go back to your journals. That's how you know it's a comprehensive answer. Okay? Don't disregard the value of using your accounting knowledge. Now, guys, let me say one more thing. Link it then to your procedure. If you're trying to check that the dollar amount is indeed correct, you got three choices actually. Number one, recalculation. Checking that it was the correct dollar amount by recalculating it. Another one is if you're going to take the journal and check it back to the sales invoice, what's that called if you're going backwards? Vouch, good. The other way you could do it is go from the sales invoice or the sales order and match it to the journal. What's that called? Do you see what I mean? Once you kind of go through this process, and the more you do this, the better you'll get, I promise. What's the risk? Then what are the accounts affected? What are the assertions? And then for this assertion, what are the procedures I can use? So feel free to either use that table or use this methodology. Either way, you will get to a correct answer, but it's giving you kind of a way to see what correlates better with your thinking. Okay? Are there any questions on this before I go on? Are you sure? Okay. Now, cost. This is interesting. The cost of conducting a test is a really important factor. Because remember, audit, we're a profit-seeking organization. We want to make money, right? And that's why it's really important for us to determine, do I need to do detailed testing or can I just rely on the controls? That's why risk assessment is so important. We want to make money. So we don't want to do more work than we have to. We want to do just enough for us to make it worth our while, essentially. Now, every single one of these types of testings that we've gone through, each of them has a cost associated with it. And that's what you see on your slides right now. The most basic type of testing is analytical procedures. And because it's the most basic, it's the cheapest. Oops. It's the cheapest. Because if you actually think about what you're doing with analytical procedures, is you're getting all the numbers and you're just like calculating based on the numbers. So if they give it all to you in Excel, all you're doing is calculating ratios or calculating trend analysis, doing percentages and so on. So it's not actually very detailed. It's quite easy and it doesn't require too much effort. Hence why it's the cheapest. It doesn't require that much time either. Okay, it's the cheapest. After that, you've got your risk assessment. Now that's the next level because you need to talk to the customer, client. You need to discuss things with the client. Now the cost involved is time. It takes time to gain that understanding. It takes time to assess those risks. So that's the next level of cost. Then you've got your tester controls, and then you've got your detailed substantive testing. So notice I just collected those ones together because they're both detailed. And remember, the more detailed, the more expensive. Okay? Now, why do I just want to focus on that for a moment? Remember, we want to make money as part of the audit. So something that audit firms are trying to do to reduce the cost of these procedures is outsourcing and offshoring, which is something that I'm going to touch on at the end of today's lecture. Okay? So there are ways that they're trying to reduce their costs because remember, if you reduce your cost, you make more money. More profit is left for you. So that's a way that they're trying to do that. Now, I've already discussed this, but I'll be quick. There's a relationship between controls testing and substantive testing. Now, we mentioned this earlier. The only time that you will go ahead and do controls testing is if you assess control risk as either low or medium. If you assess control risk as being high, you're not going to waste your time testing them. You're just going to focus on the detailed one, the detailed testing, right? You don't want to waste your time. So it's only when control risk is low or medium that you would go ahead and do controls testing. Okay? Now here's your final link. There's two more things I'll say. If you assessed it as being high, you wouldn't do any controls testing. Rather, you would just focus on doing substantive work, the detailed one. You can't rely on the controls. They don't even look good, so why would I waste my time testing them? Now, here's the thing that I was mentioning earlier. It is possible, you've got to be really mindful of this, it is possible for you to assess controls as being good and therefore assess them as low or medium, go ahead and test them and realize they don't work. In that situation, and I would like everyone to highlight this term because it will come up again later, in a situation where you test the control and you realize it doesn't work, it's called a control deviation. Okay? A control deviation is any instance that the control does not work. So if you go back to that credit limit control we were talking about, if you put in a customer's details and the system should reject but it actually accepts it, that's a control not working. That's what you call a control deviation. All right? Now, if enough of those happen, you realize, I can't rely on this control. It's not working. As a result, you would shift and do more substantive testing. That's your relationship. Now, on that note, I'm going to mention one more thing. We want to do controls testing as much as possible. Why? It's cheaper and easier because it's less detailed. So wherever we can do controls testing, we try to. But if we realize that the controls, we're not being able to rely on them because they're just not working, we're not going to waste our time. We're just going to shift our approach. Okay? It makes logical sense once you kind of put it all together. All right? Now, the relationship with analytical procedures, there's only really two things I want to mention here. Number one, as I mentioned earlier, we perform analytical procedures more so to identify unusual fluctuations or unusual movements or unusual ratios, okay? Because it's those areas where they indicate a higher risk of material misstatement, and therefore we do more detailed substantive testing. Remember, analytical procedures is the basic one. So once we find we do that, we realize, oh, this area, it doesn't look right given my understanding, we would do more substantive testing in that section, in that area. Okay? Very quickly, there's a ratio called the inventory turnover ratio. Now, the inventory turnover ratio provides an indication of how frequently the business is selling its goods. Okay? So if the business is selling its products frequently, it's going to be a high number. If it's less frequently, it's going to be a low number. Now, I have a point here. The way you interpret that, you need to think about the context of the business. I'm pretty sure I've mentioned this to you before. If you're looking at two businesses, Woolworths and Ferrari, okay, which of these businesses would you expect to have a higher inventory turnover ratio? Absolutely, okay? But if you're looking at Woolworths and you calculate the inventory turnover ratio for a bunch of different products, and you realize that one of those products, the ratio is declining significantly, guys, the risk there is called, and write this down, product, I'm not going to fit it, obsolescence. I'll just say obsolete, okay? That's the risk. Now, what's product obsolescence? That's when they can't sell it. And why is that a problem? Ladies and gentlemen, if they can't sell their inventory, they can't record it. Okay? So you want to be very, very careful here. And again, that's why we do analytical procedures, to identify unusual things. Because it's those unusual areas that we do more detailed work. All right? So that's essentially where the link comes in. So inventory turnover ratio, we use that to try to see, do the products look obsolete? And if so, if those ratios are kind of telling you want to investigate further, that's when you go and you do more your more detailed substantive testing. Now, it's very rare for us to only rely on analytical procedures. The only time that you would rely only on analytical procedures is if it's a really small account. And you know what? That's terrible terminology. Ladies and gentlemen, please write this, not material. Use the correct terminology. Okay? So not small, right? Either not material or immaterial is the other term you can use. Again, this is showing you the trade-off between our controls testing and substantive. So the only thing I really want to highlight here is where you think the controls are weak, you're not going to test them, okay? When you think they're weak, you're just going to focus on doing substantive testing. It's only when you think the controls are strong that you will go ahead and test them. Notice one thing. Substantive testing is still happening. Ladies and gentlemen, please make this note. Regardless of how good you think the controls are, And regardless of how good the controls actually are, you're always going to have to do at least a little bit of substantive work. Write that down. You cannot ever eliminate substantive testing. So regardless of the situation, so even if the controls are fantastic, you're always going to have to do at least a little bit of substantive testing. Okay? It could just be analytical procedures, but you always have to do at least a little bit. You can't eliminate substantive testing. But look on the other side. You can eliminate controls testing. So if the controls are really weak, notice this, you're not going to test them. You're just going to focus on substantive testing. Okay? So you can eliminate controls testing, but you can't eliminate substantive. And I will elaborate on this in the next few weeks as well. All right? So I will repeat this. Repetition is good. If you're hearing me say things over and over, it means you're getting it. Okay? Now, there is a video that discusses this or explains this as well, and I have put it on UTS Online. Feel free to refer to that as well. Now, the only thing I want to mention here, and I have mentioned it before, is as we all know, businesses more and more rely on their IT systems. As a result of that, our audit focuses much more resources on the IT system as well. What do I mean? Well, we know that the business uses their IT system a lot, and it processes almost all of their transactions and spits out into the information that we see as the financial report. Because of this, ladies and gentlemen, we place a great deal of time and resources into testing the system. The controls within the system, making sure, for example, that credit check control works, things like that. Why? Because in order for us to gain comfort that the information that comes out of the system is okay, we want to gain comfort that the system is okay. If the system is good, you can rely on what comes out of the system. Okay, so we do place quite a lot of time and effort into testing the IT controls and everything within the system that the business uses. Okay, pretty straightforward stuff, pretty logical. Now, one thing that I just want to mention here is when it comes to developing our audit program, we develop the audit program for every cycle. We've discussed this before. Every cycle, for example, the purchases cycle, for example, the sales cycle, and all the accounts related to it. So we come up with an audit program for each of these cycles. It is in that audit program that we determine the combination of testing that's going to be done. So how much controls testing, how much substantive testing, within substantive, how much analytical procedures, how many test of details, things like that. Now, what determines this combination is two main things, and you know this because we've gone through it. What will determine is the level of inherent risk. The higher the inherent risk, the more detailed testing you want to do. Remember what that is. The higher the inherent risk, the more substantive testing you would do, because that's the detailed one. Level of internal controls. The better the controls, the more controls testing you would do. It's a very logical link. It's a very logical link, and it comes back to what I was saying before. You gain an understanding of the business. You assess inherent and control risk. If a control risk is assessed as low or medium, you go ahead and you test them. If it was assessed as high, you just focus on your substantive testing. If you test the internal controls and realize they're not working, you shift to substantive testing. And at the end of this process, guys, you evaluate your evidence and you come up with your opinion. That's it. That's the conceptual way of how this whole process works. So if you can wrap your hand around all of that, it's just a matter of now zooming in and looking at the detail of it, okay? But you're doing really, really well. So when you design that audit program, remember, another way of thinking about the audit program is it's the set of instructions, it's the recipe, okay? It's how you're going to conduct your audit. What are the testing that you're going to do? Now for each one, you're going to set out which tests you're going to do, how much controls testing, what substantive tests to transactions, analytical procedures, and details of balances. How much of this are you going to do? Now, in particular, one thing I'll mention, I might as well mention it now. In particular, you're not only noting which of these you're doing, which combination, guys, you're also noting detail. What do I mean? Who's doing it? How are they doing the test? When are they performing the test? What evidence are you collecting? What's incredibly important about this stage when you're developing your audit program is you have to be detailed. Okay? The detail is the most important part of documentation, which I'm going to talk about in just a minute. Okay? So you must be detailed exactly who is supposed to complete this test. When are they supposed to do this test? How are they doing it? What's the detailed instructions of how they need to complete the test that they've been assigned? What evidence should they be collecting? What's the sample size that they should be collecting? What's the conclusion that they reached? What's the testing results? Okay, so it's really important that all of this is set out. Now, the next 2 slides goes through exactly what I already discussed. So I'll let you have a read of it. But again, the key notion here is you gain the understanding, you assess the control risk. Based off that, you determine how much controls testing and how much substantive testing you need to do. Let me ask you a really quick question. Which one do we do first? Controls testing or substantive testing? Yes. Okay, good. Controls testing. And at the end of this whole process, that's when you get your evidence, you evaluate it, and you come up with your conclusion. So I'll let you just have a read of these. And this is essentially how the textbook has set out the process. So phase number 1 is plan and design the audit approach. This is what we spoke about at the very beginning. This is what I call the planning phase. Okay? This is when you're gaining the understanding of the business and how it works and the controls within the business, and you're making your risk assessments. That's phase 1. Phase 2, now they've broken it down. I combine these into stage number 2. So this is 1, this is 2. This is what I call the testing stage. Okay? This is when you go ahead and you actually complete all the testing that you have designed. You collect your evidence as part of that testing, and you evaluate it. You come up with your conclusions. That takes you to the final stage, which is stage 3, ladies and gentlemen, completion of the audit. This is when we look at all our testing results and we use that to determine our final audit opinion, which goes in the audit report. That's it. That's the process. Now, what we focused on today, well, up until now, we've been focusing on the stage 1, the planning stage. Now you're seeing, well, from the planning stage, you've determined what's the strategy, and now you know the different tests that you can perform. So this is the testing stage, and this is going to be our focus for the next, I think, 3 weeks. Okay? And at the end of the semester, which is in a couple of weeks, not long to go now, we'll discuss the completion stage. Okay? So you're doing pretty well. It's not as difficult as it seems, but it is a matter of understanding how everything links in together. So today we're focused on these things. You need to set out in an audit, an audit program. You want to set out what your objectives are, as in what are the assertions that you're testing. What is the detail of the test that you are performing? Remember, you have to be very detailed in setting this out. What are the evidence that you're going to collect? How much evidence? When are you going to collect it? And so on and so forth. Okay? Now, the next 2 slides, the reason I've included these ones is it does try to show you the link between the elements we've discussed. So, for example, the phase of the audit, the types of testing that you would do in that phase, and the types of evidence, or more importantly, the types of procedures you would do as well. So this is one way for you to kind of get your head around it. Use it as a reference point if you like. If it doesn't work for you, that's fine. Go back to the other way that I was describing to you earlier. And now we move over to documentation. Before I do that, ladies and gentlemen, are there any questions on what we have gone through? Okay. It's a lot of this, and I know I've mentioned this to you all before, a lot of this comes down to practice. Okay? A lot of it comes down to practice and application. Remember what I always say, knowledge doesn't become understanding until you apply it. So on that note, next week we're going to be discussing internal controls. I'm actually going to bring a practical exercise into the lecture with me so you can see not only the understanding of how it works in theory, but also how you would do it in practice and designing tests as well. So we'll do that together next week. So documentation. Why do we need documentation? Ladies and gentlemen, at the end of the audit, we provide a legal document called the audit report. This document can expose us to legal liability if we are found to have been negligent in the performance of the audit. So we need to make sure that we document literally everything that we do. in the event that an allegation is made or a lawsuit is brought up, we need to be able to justify everything that we did. And more importantly, the conclusion that we came up with. Okay? So documentation is incredibly important. And before I go into the slides, can everyone please write this down? Here's your reference, ASA 230. Okay? ASA 230 is the auditing standard that deals with documentation and what needs to be documented as part of the audit. So what is the purpose of audit documentation as we have discussed? Excuse me. Auditors, so per ASA 230, which I haven't noted here, 230. As part of this standard, the auditors must document every single stage of the audit, and that includes the exact tests that you have performed, how you have performed them, when you have performed them, the evidence that you have collected, and ladies and gentlemen, the conclusions that you have reached. So all of these things must be included within the documentation. So as it says here, the procedures performed, the evidence collected, the conclusions reached. What I would like everyone to do is to add an additional point, okay? In terms of the things we need to document, it's not just specifically the testing. It's also one more thing, and I would like everyone to write this down. We also need to document the justifications behind our judgments. What do I mean? As you all know, because we have started discussing things like this, we do exercise quite a lot of judgment as part of the audit process. Let me give you just one example. Go back 2 weeks to our last class. We discussed materiality. In order to calculate materiality, we needed 2 things. We needed an account balance as a base, and we needed a percentage. Both of those required us to exercise judgment. Okay, so we exercise quite a lot of judgment as part of the audit process. So we need to document and justify how we have reached those judgments. How did we pick that particular base for our materiality calculation? How do we determine the percentage that we used in calculating that base? So we need to justify that because, guys, negligence, it's more likely that they're going to bring negligent case against you because of a judgment that you've made. So you should be able to justify the judgment calls that you have made. Now, in terms of why we need documentation, it's not just because of the legal side of things, but documentation also really helps when it comes to managing the audit, planning. If you have a really big organization that you're about to audit, you need to make sure that you're planning the right, allocating the right people to do the right tests, to make sure you're covering off all the accounts and all the assertions. So it can actually really help you when it comes to planning the audit in the first place, making sure you're covering off on everything you need to cover off on. Take that, bring it to the ends. Guys, it also helps with the review stage as well. Because once you've documented who's performing which test, when they performed it, and what their conclusions are, it allows people to review that in the order that it's there. Okay? So you can then make sure that the work of the juniors have been approved by the seniors or the in charge. The work of those individuals are reviewed by management and the work of those by the audit partner. So it does facilitate the review of those as well. Ownership and retention. Ladies and gentlemen, again, ASA 213, we need to, sorry, I thought it went out again. We need to hold on to our audit files for at least 7 years. Okay, so 7 years is the period of retention that we need to hold on to our audit documentation for 7 years after the end of the audit, after the completion of the audit. Okay, and that's per ASA 230. And that's, again, if anything does come up, then the evidence is there to be reviewed, essentially. Confidentiality. I'm just going to make one note here. This is one of the fundamental principles of professional accountants under APES 110. Okay, so it's one of the 5 that we went through. Now, what we said back, this is week 3, I think, when we discussed this. What we said then is the financial report and the information in the financial report, it's not public knowledge. As a result, we've got to keep that information confidential, okay? We can't tell anyone. We can't use it for our own personal gain, and we can't use it for the gain of others. Ladies and gentlemen, the same thing applies to our audit documentation. We got to keep that information confidential as well. We cannot disclose or show our testing or our results or the evidence that we've collected to anybody else. One thing I mentioned, and this is similar to what you were told before, the only time we can show the working papers to somebody else is if we have the express permission of the client. Okay? So that's the only thing. Key thing, keep it confidential, do not disclose to others. Now we have two types of audit files, okay? Is anyone here having experience with audits? I know some people are cadets, yeah? Okay. So we have two types of audit files. Now again, very logical. Number one is called the permanent audit file. Ladies and gentlemen, the best way for me to explain this one is that the permanent audit file, as the name suggests, holds all the client information and all the documentation that applies to more than 1 year. More than 1 year, okay? What do I mean? The things that we would refer to in an audit of greater than let me rephrase. It's all the documentation we would refer to in more than one audit of that client. What do I mean? For example, key company documents. Key company documents that don't change over time. So instead of us getting it every single year, we'll just keep it in our permanent file and continuously refer to it. Other things, really important information about the internal controls within the business or the accounting policies that they use within the business. Things like that, things that don't really change over time would all go into your permanent audit file. The results, long-term contracts. It's long-term, so it's going to be more than a year, okay? A really good one there could be loans. Yeah, they're loan contracts that exceed over 1 year. The important thing about making sure you're mindful of their loans, LC, not learning catalytics, I've got my LCs mixed up. What is it? Loan covenants, that's it, okay? Loan covenants, because remember, loan covenants is a really big risk area for us, okay? So we want to have the loan contracts so we can be mindful of the loan covenants related to them. Results of prior audits as well. We usually keep record of all the previous audit reports that we've given to the client also. Again, key notion, greater than 1 year, okay? You're going to be able to refer to it for more than one audit. That naturally goes into the next one, which is the current audit file. And as, again, the name suggests, this is all the documents or the client information for just that year, okay, for that audit. What do I mean? The audit program for that year. The evidence or the trial balance of documents for that year. The journals for that year. Evidence that we gathered for this audit in this year, okay? So invoices or anything like that that we gather for that particular year's audit will go into your current file. If it's something that exceeds that 1 year period, so if that's something that we're going to use again next year, we could put that into the permanent file. So it's a pretty clear distinction between the two. Now, when it comes to working papers, and this is really important, I might do this in a different slide actually. I'm going to add a page, but I want everyone to stay on this page, okay? I'm going to explain something to you. I'll mention this first. Every working paper has to possess certain characteristics. This is really, really, really important, and it might come up next week. So things that the documents need to include. Number one, the client's name. Probably a good place to start. Make sure you know who it is that you're auditing as part of that particular test. The period that it covers. Okay, the period, so the financial year that you are looking at. The description of the content, what does that mean? Guys, the procedure in a detailed explanation, what is the test that is going to be conducted or has been conducted? Initials of the preparer. This is actually really important. When you look at a test, you need to know who did this. Okay, who did this? And usually what you'll see is on the working paper, on the top right-hand corner, you'll see the initials of the person who actually conducted the test. The date at which they conducted the test. And it says here in index code, we usually call these references, or actually just references, it's a page reference. And usually with that one, every single document, every single working paper will have a unique indicator. And what do I mean by unique indicator is it'll have some form of reference. So sometimes we call them, work paper 1 is W1, work paper 2, W2, so on and so forth. And the reason why the references is so important, guys, everything I'm telling you right now, very important. With the references, what's so important about them is if you take out a piece of paper from the audit file because someone wants to look at it, you need to know where it goes back in. So you need that reference as a way of knowing where it goes into the file. Another thing, if you're referring to this document in another document, how are you going to refer to it? You use the unique reference, all right? And that facilitates what's called cross-referencing, which is when you're referencing one document in another. And that's a really important task that needs to be done because it allows for, oh, actually, you know what? Let me write this down. This facilitates the review of the information as well. Okay, so I'm just going to show you what an example of a working paper would be. I'll do it on a new page. Okay, so for example, this is your working paper, all right? And what you'll generally find is the following. So on the top right-hand corner, you'll see probably three things. The first one is you'll see who prepared it, so you'll see their preparer's initials. You'll see the date. And you'll also see, as I noted earlier, the work page reference. Now, every organisation does this in a slightly different way, but the key point is that this reference, it's unique, which means you won't have two documents with the same reference, okay? Now, that's on the top right-hand corner. Then on the first, when you first actually see the document, on the top you'll see kind of like a heading, I suppose. And here, you will see the client's name, okay? So you want to know this test is in relation to which client. You want to know for what year it relates to, so the date or what period, actually, you know what? The period that it covers, that's probably a better way of explaining it. And also the name of the test. What are you doing? Is it a cutoff test? Is it a, what is it? What's the test? What's the name of the test? Now guys, this is still, we're not even going to detail yet. Okay, you just set up your document. The next thing that you would do is here, and that's when you actually talk about the procedure. You actually write down what is the test that was performed in detail. Please make sure you write this down in detail. What do I mean? You don't just say vouch sales. You would say take a sample of sales journals and match the details within that sale to the corresponding sales invoice or sales order or whatever it is. You have to be really detailed, okay? Why? Let me say one thing. You have to be so detailed that anyone can read your document, can read this procedure and know exactly what to do. That's your reference, okay? That anyone can read it and follow the instructions without any confusion. And then naturally, at the end, you would have your testing results and your conclusion. Okay? That's what it would generally look like. And again, it will probably go for longer than a page, but that's what it generally looks like. Okay, so please be mindful of these elements, and this is the characteristics of a good work paper. Now, this is what I was saying earlier. Again, it has to be in sufficient detail so that anyone can read it and clearly understand the work performed, the evidence collected, where it was collected from, and the conclusions. Okay? Now, the only thing I want to say here is, and if you do have audit experience, you would already know this, back in my day, everything was on paper, everything. So we would have, depending on the size of the client, we would have so many audit files with so much paper in each of them. Nowadays, because businesses will rely on IT so much, evidence has become more electronic. Now, what's also happened from the audit perspective is that they've actually moved away from paper. If you're doing audit now, you are experiencing what's called, a paperless audit. And what happens with a paperless audit is we don't actually photocopy pages anymore and put them in a file. What happens is you scan the documents and you place them onto a particular program that the audit firm uses. So it's actually moved away from doing things on paper, and it's rather now all in the system, in the program. So it's now what's called a paperless audit. So we have moved just as our businesses have. Final thing, as I mentioned earlier, one way that audit firms are trying to reduce their costs is through offshoring. Now, people often get offshoring and outsourcing confused. They are different. Outsourcing, let me do it this way. Outsourcing is when a business gets another business to do a task on their behalf, but that business can be in the same country, but it's just a different business, okay? So company A can get company B to do something for them. Company B can be anywhere. They can be here or they can be overseas, but it's a different company. Offshoring, guys, is when you get, it's the same business that you're getting to do it for you, but it's just located in a different country. So a really good example of that is when they actually set up centers or they set up branches in another country like India or the Philippines, and they actually get the branch of that company, so KPMG branch in India, for example, to complete the work on the behalf of the Australian KPMG branch. Okay, that's offshoring. So outsourcing is to a different company. Offshoring is within the same company but in a different branch overseas. Okay, that's the difference. Now, why do they engage in offshoring? Two main reasons. Number one, to get more work done within a smaller period, within a shorter period of time. So if there's a deadline and there's a lot of work to do, they might recruit people, the branch in the overseas version of the company, so, you know, as I mentioned earlier, KPMG in India, to help them do some testing and meet their deadline. But probably the key reason, it's a cost-saving measure. Because usually these offshored branches are often located in countries that have a lower labour cost associated with them, okay? So that's essentially the two main reasons why we do it. It's, lower cost staff, and they can perform repetitive tasks, for example, tracing and vouching. Now, what are the risks? Ladies and gentlemen, oh, by the way, none of this is in your textbooks. This is just what I've added because it's important for you to know them. One of the key risks relating to this activity of offshoring, we don't have any guidance. There's no auditing standards that deals with how we need to actually handle the offshoring process itself. Also, how do we know that the work has been done correctly? If it's done in a different country, it makes review much harder. Okay, so how do we know that they're actually doing it the way that we want them to do it and they're checking it correctly? Now, this one's interesting. Remember, we always come back to, we don't want to get sued. Well, research has showed that jurors are less likely to have confidence in audit work that's actually done overseas. So if there is a case of negligence that you are involved with that follows getting offshoring done that follows using offshoring, it might not help you in that legal situation. And finally, a question is, well, how much could you offshore? And more importantly, how much should you offshore? Where's the line? Where's the limit? Again, no guidance on it. Okay, so it is an activity that is being done more and more now by businesses, again, because it does lower their costs and result in more profit being left over, but there are a lot of risks and question marks surrounding it. Okay, any questions? You've done amazing. Have a fantastic week. Enjoy your tutorials. I will see you next time. Well done, guys.